Welcome to Smart Wealth with Joshua, and Merry Christmas to you.
Your daily stock analysis and catalysts talk. Today we're looking at L3Harris Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. L3Harris has really shifted its whole operational story over the last couple of years, and it all kind of culminated in this spectacular Q3 2025 performance.
It really did. When you look at that Q3 report, the first number that just, leaps off the page is the organic revenue growth. A robust 10%. For a defense giant, that's a huge signal.
It absolutely is. 10% growth in an industry that's often happy with low single digits. It shows some serious momentum. Total revenue hit about $5.7 billion, which is a solid 7% year-over-year increase.
But the real story was on the earnings front, right?
Exactly. The real validation. They delivered non-GAAP diluted EPS of $2.70. It's up 10% from the prior year. And it beat what the analysts were expecting by a good 10 cents.
So it's that classic beat and raise scenario. Management didn't just meet the bar, they raised it for the whole year. We saw the full year 2025 revenue guidance get bumped up to around $22 billion.
And critically, the EPS guidance got a boost too, to a tighter range of $10.70. This isn't just optimism. This is management saying, look, we have clear visibility, and what's coming is even better than we thought a few months ago.
Okay, but anyone can, land a big contract. The hard part is execution. What's the proof that they're actually running a tighter ship?
It comes down to one metric for me, and it's incredible. Operational discipline. They have now achieved 8 consecutive quarters of year-over-year adjusted segment operating margin expansion.
That quarters.
8 straight quarters. Think about that. With all the inflation, supply chain issues, fixed price contracts, to consistently expand margins for 2 full years is it's profound.
That margin hit 15.9% in Q3. So this tells you the growth isn't just coming from, low margin deals. It's quality growth that's dropping straight to the bottom line.
Precisely. It proves they can convert their huge backlog into high-quality, profitable revenue. This changes the whole investment story from just a cyclical defense play to an execution-driven growth story.
So let's pivot a little to their competitive position.
Right.
What is it that L3Harris does that makes them so defensible? Where's their moat?
Their moat is built less on, say, building the biggest ship or the fastest jet, and more on deep mission-critical integration.
Okay, mission-critical integration. What does that actually mean for someone not in the industry?
It means really high switching costs.
Yep.
So imagine the U.S. Navy has L3Harris communications gear, sensors, and data links across an entire fleet of destroyers. Those systems aren't just boxes you can swap out. They're woven into the ship's own combat software, the crew's training, the maintenance schedules. To rip that out and replace it with a competitor system would take years of work.
So once they're in, they are locked in. That secures revenue for decades. So does the balance sheet look strong enough to support this?
It does. Their financial health is quite solid. The debt-to-equity ratio is around 0.56. In this industry, that's seen as moderate leverage. It gives them flexibility. And liquidity is fine too, with a current ratio of 1.15. They're stable.
Stability is good, but what about predictability? How far out can we really see their revenue?
And that's where the order book is just the most important piece of the puzzle. Their book-to-bill ratio in Q3 was exceptionally strong at 1.2x.
Can you break that down? Why is 1.2x so significant?
Sure. A book-to-bill over 1.0 means your order backlog is growing. So for every dollar of revenue L3Harris recognized in the quarter, they added $1.20 in new future business.
So their to-do list is growing faster than they can check things off it.
Exactly, and that provides really strong revenue visibility well into 2026. It de-risks their future earnings in a big way.
That kind of visibility sets the stage perfectly for some of the big catalysts, especially those massive contract wins. What are the big ones we should be looking at?
Okay, the first one is huge, and it speaks to their international reach. They landed a $2.2 billion award from Korea for an airborne early warning and control system.
A huge foreign military sale.
A massive one. It establishes them as a key global player for these very sophisticated systems. It's a long-term revenue stream right off the bat.
And that helps with the concentration risk, being too reliant on the U.S. government. The second big win, that's all about the future of warfare space.
Absolutely. The $843 million Space Development Agency contract, that's a landmark deal. It's for 18 infrared missile tracking satellites.
And these are part of that bigger architecture, right?
The proliferated warfighter space architecture. You can sort of think of it as the military's future high-speed internet and surveillance network in orbit. L3Harris is a cornerstone of that whole build-out.
And the third win validates their push into hypersonics.
That's right. They got an order for 60 hypersonic motors from Kratos Defense and Security Solutions. This is a huge stamp of approval on their propulsion tech. It shows other key players are integrating their systems.
All these announcements definitely helped the stock. We saw a clear reversal, right? 3 straight days of gains, including that 2.66% pop.
For sure. But we do have to talk about some of the mixed signals, particularly on the institutional flow side.
You mean the insider selling?
The insider selling, yes. The CEO sold some shares, about 14,000, and a big fund, Voya, reduced their stake. When people see headlines like that, the alarm bells can go off.
So how should we interpret that, especially when the stock kept going up? Is it a red flag?
I don't think so, no. You have to look at the context. This kind of selling is often just. It's routine post-earnings. Executives exercise options. They sell some to cover taxes. It's financial planning. Same with a fund like Voya rebalancing a position that's done really well.
And the fact that the price kept rising suggests the broader market saw it that way too, that the buying from other institutions just absorbed it.
Exactly. If it were a real sign of a fundamental problem, the stock would have likely gone flat or down, especially after such a good report. The market basically shrugged it off.
All right, let's flip the coin and talk about the risks. The big one, the undeniable bear case here, has to be the valuation.
It's the elephant in the room, for sure. The stock is trading at a PE ratio of about 31.1x on 2025 earnings. That is a significant premium compared to the historical average for the defense sector.
And that premium creates risk. If that 10% growth rate slips, the market could pull that multiple back really fast. So what's the argument for paying 31 times earnings for a defense company?
The argument is that L3Harris isn't really a traditional defense company anymore. They're focused so heavily on the high-growth areas, digital systems, space, advanced sensors, that they're acting more like a technology platform provider.
So they deserve more of a tech multiple than an old-school defense multiple.
That's the case being made. And the justification is in the numbers we already talked about. The 8 straight quarters of margin expansion and that 1.2x book-to-bill. The market pays for that kind of predictable, high-quality growth.
What about the macro risks? The U.S. government budget battles.
That's always a risk, absolutely. Government shutdowns, continuing resolutions, those can cause delays. The company cites it as a material risk, and they're right to.
But how is L3Harris maybe a little more insulated from that than some of their peers?
2 ways. First, diversification, like that huge Korea award. But more importantly, the U.S. programs they're winning are considered the absolute highest strategic priority.
Like the space architecture.
Exactly.
Yeah.
That program is not a nice-to-have. It's considered essential for national security. Those are the last programs to get cut, which insulates them from a lot of the short-term political drama.
That makes sense. Okay, looking ahead, what are the key dates or events we should be watching over the next 6 to 12 months?
The immediate focus is the Q4 2025 earnings release. We expect that late January, maybe early February 2026, analysts are already looking for strong numbers, about $5.76 billion in revenue and $2.83 in EPS. Beating that would be huge.
And after that, what's the next big potential catalyst?
Management has said they're going to detail their 2026 financial framework, probably on the earnings call or at an investor day. That's a massive event. It will give the market a clear, multi-year roadmap for profitability.
So putting it all together, what's the final investment summary here? What's the elevator pitch?
I think the thesis is that this is a high-conviction core position for a growth-focused portfolio. It's backed by just flawless execution on their margins and this incredible multi-year visibility from their contract wins.
And what does that mean for the stock price over the next year?
Well, the combination of that earnings momentum and the geopolitical tailwinds, I think it supports a realistic 6 to 12-month price target in the, say, $320 to $340 range. That's about 8 to 15% upside from here. And it feels like there's strong support down near $280. The most compelling thing here isn't just the Q3 beat. It's the multi-year revenue visibility that you get from these huge programs like the Space Development Agency build-out. That fundamentally changes the risk profile for this kind of investment for the long term.
Don't forget to subscribe, and we'll catch you on the next deep dive into the markets.